most people completely focus on saving their deposit, but they end up losing thousands of pounds when it actually comes to buying their home. And most of the time, they don't even realise they're doing it, because the real savings don't come from one big decision. They come from a number of really key decisions throughout the process of buying your home. So in this video, I'm going to show you exactly where you can save money and exactly the moments where people end up losing money when buying a property. My name's Joseph, but you can call me Joe. I am a mortgage and protection advisor in the UK, and I'm going to take you through all the different ways you can potentially save yourself some money when buying your home, potentially saving you thousands of pounds. And just a quick note here, one of these moments can actually save you thousands of pounds just by itself, let alone the others. Now, the first moment is actually before you even start searching. A lot of people skip this straight away, but speaking to a mortgage advisor really early on, as in before you're even looking at properties, can be the difference and potentially save you thousands and thousands of pounds if you plan accordingly, because speaking to an advisor allows you to plan your own finances for the short term, medium term, and long term, but also saves you from wasting time as well. So speaking to an advisor not only allows you to understand your budget, but stops you going into it and avoids an unrealistic expectation and an unrealistic budget, which again, not only saves you money, but also saves you a lot of stress. And put simply, not understanding your finances early on in the process can cause you to end up overpaying for not only the property, but the mortgage itself, or just chasing the wrong properties altogether. So either scenario is a bad one to go into. So your priority for moment number one is speak to an advisor early, understand your budget early, and also understand your own finances early. The better you plan, the more you save. Now, moment number two is actually when you're searching for the property itself. And to be honest with you, most people think saving money at this stage isn't possible, but it is if you know what you're looking for. Now, there's three key things you should be looking out for here: price reduction, time on the market, and motivated sellers. Those three things nicely connect up to each other and can really help you find an opportunity on the market. And potentially the longer a property sits on the market for, the more scope there is for conversations, and the more conversations you have potentially opens up the doors to further negotiations. Information is so important when buying a home. So the longer a property sits on the market, the more of a conversation there is, which means the more information you can get out of it from an estate agent. So again, it's so important to understand that during the searching phase is where you can find opportunities that's not only right for you now, but right for you in the long term. So you can win massively and save thousands of pounds just by searching in the right way, which nicely leads me on to moment number three, which is making an offer on a property. This is single-handedly where the biggest potential savings come into place. And again, if you've tackled moment one and number two, perfect, you're coming into moment three ready and prepared to save some serious money. But again, it's worth highlighting, this is also the time where you can actually end up losing money because you negotiate poorly. Now, something I always say to my clients is people spend hours trying to find the perfect hotel and save £200 on a holiday. They'll go through several sites. But when it comes to buying a home, there is a weird approach where people just seem to go for the guide price because it's the easy option to do. They don't want to upset anyone. They don't want to compare and have these uncomfortable conversations. If you're willing to spend hours trying to save £200-300 on a holiday, please do your research and take your time for moment number three, because putting in your offer is the best opportunity to save thousands of pounds. And it's an opportunity that most buyers miss out on because they just go for the guide price. So you already hear what you're thinking. How do I get a good deal on a property that's below guide price? Now, there's two really key components here that I tell every single one of my clients to consider. The first one is read the seller's situation. You are buying a property off a human, potentially even buying a property off a family. There are potential emotional connections to that property that you need to consider. So rule number one there, which is read the seller's situation, kind of falls back on do not upset the seller. So don't try really lowball someone because you're potentially upsetting them, tainting your relationship, forcing the situation to basically not allow for negotiations. And factor number two, which is incredibly important, is don't assume the asking price is fixed. Now, the asking price is the asking price. There are so many different factors that go into that number that you see on Rightmove, Zoopla, or on an estate agent's website, but it could literally be as simple as a estate agent's gone out and they've said, we can get you this amount for this property in order to win the seller's business. Remember, the estate agent works for the seller. So if they are saying, I can sell your house for £350,000 because they want to beat out competition that said £330,000, that is a very real scenario that happens every single day. So if you're looking at a new listing where there's been no price changes whatsoever, there is real big potential that it's already been listed for more than it's worth. Now, I've already said this is the most important moment, but I have to explain. If you're selling a property, you need to position yourself in the seller's place just for one moment here so you can get the best out of the offer. You have just received 2 offers for your property, both the exact same price. So 2 people are willing to pay the exact same amount. The first one over here is not prepared. They don't have their mortgage in principle. They don't have their proof of deposit. They basically come saying, we want to give you this amount of money, but we can't show you that we can afford that amount of money just yet. The second person has come to them with the exact same amount of money. They've got their mortgage in principle. They've got their proof of deposit. They've got their solicitor. They've got their mortgage advisor. Everyone is ready to go on this side. Which one are you picking? The person that's not prepared, offering the same amount of money, or the person that is prepared, offering the same amount of money? So again, position yourself as best as humanly possible, because that is going to potentially increase the chances of your offer being accepted for a discount. Moment number 4 is an interesting one. It's the mortgage itself. And this is where people focus on completely the wrong thing. And it's again something that I see day in, day out, and it needs to be discussed. Now, there are 3 different factors that we need to consider when looking at mortgages and where there's potential to save money. Now, the first one is rate and fees. So a mortgage is composed of an interest rate for a fixed period of time, plus potentially a fee or no fee that can be added or not added to the loan. So this is essentially a combination, an interest rate and a fee from the lender. Now, the thing you have to consider when looking at fees and interest rate is the total cost of the fixed period. So if you're looking at a 5-year fixed deal, you need to consider what the cost over the 5 years is for the, let's say, a fee-free version, which is a higher interest rate but with no fee, versus a product that has a fee with a lower interest rate. Now, again, without looking at an exact deal, if you're borrowing a lot more money, then potentially there are savings available for going with a product that has a lower interest rate but a fee attached to it. Again, you can either do this yourself and do the maths yourself, or you can get an advisor to do it for you and recommend the most suitable option, which may or may not include a fee. This nicely leads us on to the second part of mortgages here, which is upfront fees or adding the fee to the loan. So now, if your mortgage product does have a fee, most oftentimes you're going to have the ability to add that to the loan. And you're probably thinking, right, well, this video is all about saving money, so what should I do with this mortgage product fee if it exists? Now, if you have the ability to add it to the loan, it's a really interesting conversation. It's a conversation we have with our clients all the time, where you don't really want to invest in that property when you're not the owner. Paying the fees up front rather than adding it to the loan most oftentimes means you have to pay that fee on application. With most providers, if it's a product fee, that will be refundable if it doesn't go through. Not every provider, but most of them. But that is a bit of a pain. You've already lost money, potentially £900, maybe £1,000, maybe £1,500 towards a property that you're not the owner of, where that could be spent on other things in the meantime. Whereas there is an option where you, with most lenders, can add that to the loan. So you're basically going to pay interest when it's added onto the loan for that difference, which, depending on the loan size, depending on the interest rate, could be a few pounds a month added on to your current total, but you're not paying that mortgage fee up front. This just means you don't have to pay the fees until you're the legal owner of the property, or at least you don't start paying the interest on those fees until you're the legal owner. Again, reducing your upfront costs and protecting yourself, potentially saving yourself some money. If you want to go one step further, once you're the legal owner of the property, with most providers, you'll have a 10% overpayment facility where you can pay off the mortgage fees straight away the day you move into the property when you've got your account set up online, which means you never pay any interest on the fees added to the loan. Again, it's a smart thing to consider, which means you've reduced your upfront costs, you haven't incurred any additional interest, therefore you've saved money. And again, this is really, really powerful if you were to ever lose out on a property at a later stage, because you've reduced your upfront fees by planning in a smart way. And the final thing to consider, and again, we briefly mentioned it, is your overpayment facility. So mortgages will often include a very generous overpayment facility where you can essentially pay off the capital of the mortgage, which means you don't incur any interest charges on these overpayments. It purely comes off the balance of your mortgage, which again for most providers is 10%, but there are a couple of providers out there where is a 20% per annum budget based on your mortgage amount, which again for most people is more than enough. But taking advantage of overpayments can massively decrease the amount of interest you pay over the term because you're reducing your balance faster. So again, a really smart way to plan, especially if you have pay rises throughout the term of the mortgage. So it's key to remember here, a better structure can save you far more than just finding the lowest interest rate or the lowest monthly payments. Because again, you need to remember your mortgage term and the way you set up your mortgage is how long you pay that mortgage across. So if you clear your mortgage in 30 years instead of 40 years, there's 10 years there where you're not paying interest on your mortgage. So the faster you clear it, the better it is for yourself, the less interest you pay over the long term. So don't just try find the lowest monthly payment, because again, that might not be right for you. Moment number 5 is a really, really important one. It's after your offer is accepted. This is where a lot of buyers start losing money without even realizing. Now, the first thing to consider here is going around private surveys in the wrong way. The first mistake is doing it at the wrong time. So maybe going in with a private survey before you've had a mortgage offer or a successful lender valuation. It could be too early. Again, potentially investing money in a property you're not the legal owner of without any sort of indication from the bank that we can actually get it done. And the next consideration with surveys is actually going for the wrong survey. So some people go for a level 2 survey when actually it would have been better to go for a level 3 survey, and some people go for a level 3 survey when actually it's better to go for a level 2 survey. Now, again, a level 3 survey is the most detailed report you can get on a property before becoming the legal owner of it. And going for this is going to essentially give you any and all information on your property within the guidelines of the level 3 survey. It's worth actually discussing this with a professional surveyor when you have an indication that your mortgage is either offered or about to be offered. Because again, getting the right survey at the right price is incredibly important, and it's information that can save you thousands and thousands of pounds. But without a private survey, you have put a lot at risk. And then the next mistake people make with surveys is almost the obvious one, which is not having them. So a lot of people skip a private survey and they take the save now, pay later approach, which isn't a smart thing to do, especially if there are problems with the property. Now, there's a massive, massive if there. But you are taking a gamble with potentially hundreds of thousands of pounds, because that's how much you're probably paying for your property, in order to save maybe £500 to £800 on a private survey. Another big mistake I see a lot of people making after the offer is accepted is paying too early for a number of different things. Now, the first one is going to an advisor where they charge upfront fees, where it's not payable on completion or no win, no fee. Because again, you're paying for an advisor to help you with that property. If something was to fall through that was no fault of your own, you need to make sure that there's something in place where you either get your money back or you've got like a service guarantee where they actually end up helping you with a separate property in the future. Again, the less upfront fees, the better, because it could potentially save you hundreds, if not thousands of pounds if things were to fall through at no fault of your own. Again, really prioritize trying to find a no win, no fee mortgage advisor like ourselves, because it can save you a lot of money. And the other thing people end up paying too early in a lot of situations are searches. Now, this is something where, in part, it's estate agent's fault, because they want people to invest in searches, because they want people to be invested in the property that they're selling, and obviously give the seller a little bit of security, knowing that you've invested money in a property you're not the current owner of. But what I would say is if you want to protect yourself, anywhere from £300 to £500, which is the property searches, which are relatively early in the process, I would try and hold back from paying these searches until you've either had a successful mortgage valuation, therefore the property is in good condition and the lender sees it as proceedable, or a full mortgage offer, which means the lender's not only happy with the property, but they're happy with you as the buyer. This just means that if anything was to happen, you know that you've done everything in your power to make sure that you've not wasted the £300 to £500 on the searches. So I can already hear people asking, so what is the biggest mistake people make and what is stopping us from saving thousands of pounds? Well, it's not just one trick. It's understanding where money is lost in each and every moment. We've covered 5 of those really key moments. So if you tackle each moment step by step in the right way, with the right planning and the right advice, you're going to ensure that you are potentially saving yourself thousands of pounds by not wasting thousands of pounds. Smart buyers don't just try to get the cheapest house. They make better and informed decisions throughout the entire process as each and every moment comes and passes. And if you want help making sure you are saving money and potentially not losing money at each and every moment through the process, you've come to the right place, because that's exactly what I do every single day. You can go to the description of this video where you can find a link to book in a meeting with myself, where we'll have a 15 to 30 minute conversation going through what you need to achieve, what you're looking to avoid, so that we can plan accordingly to make sure that you're saving as much money as humanly possible when you're buying your home. Find a date, then find a time, book in the call, and we can go through anything and everything in a nice, concise phone call to make sure that you're best prepared to save as much money as humanly possible. Now, I have made the absolute perfect video for you on your screen right now, which is covering the hidden costs of buying a house in the UK. You're going to fully understand all the potential costs of buying a home outside of the deposit. So again, when it comes to planning and saving money, you need to plan accordingly, and the only way you can plan is to understand the total costs. Click the video, understand the hidden costs, and I look forward to speaking to you very soon.